really means to live life golden. Yeah, we're golden, baby girl, we're golden. They're about to see us shine, cause we're golden. They can never break us down, cause we're golden. They're about to see us glow, cause we're golden.
Danny, welcome to the podcast.
Mate, thanks for having me.
For those who don't know, I've mentioned a few times in previous podcasts, I've mentioned yourself and Cali Partners, Northern Beaches as, you know, saviors in a sense, and but just how, you know, I've spoken openly, and I think me and Ice actually spoke about you guys last week. You know, I mean, I think for myself personally, if the first piece of advice I would give to someone who was starting a business is to get a great accountant.
Love that.
So what I mean, and the goal with these episodes with yourself is to get your expertise, because you've taught me a lot, and so has your team. But our goal is to just, you know, continue to offer value to our listeners with, you know, some you know, specific education, which is really important, you know, and no better person to do it with than yourself, mate.
Mate, Keen, you ask actually really good questions. So it's been easy to teach you stuff because you ask the right stuff. But I think to your point, no one goes into business wanting to talk about debits and credits and numbers, and they kind of treat it as an afterthought. So definitely agree about getting a great accountant. Don't just go to your dad's accountant, because that's what most people do.
Yeah.
So yeah, it's just one of those first things you need to solve.
And like one of the things that I found with you guys, and this is, you know, we're not trying to shameless plug here, but it's a really important point, is that if you're having to ask your accountant to do things, or you're having to ask them, like let's say someone says, "Oh, my accountant's doing this for me," and you're like, "Well, why isn't mine doing this?" Or if they're not reaching out to you and proactively actually trying to help you, and you know, teaching you things, that's the biggest difference that I've found working with you guys. It's just been, you know, amazing, and kind of, I look back at a lot of the education that I've done and the money that I've spent, you know, in mentorships and these kind of things, and I've probably doubled up, you know, in terms of what you can learn when you do have a great accountant.
Yeah.
So
we try and do that on purpose. We sit client side, like we don't treat it like, hey, we're just doing your BAS and here's your GST. We want to be on that business journey with our clients that whole way through. So yeah, it's find the people that can do that. If it's us, awesome. If it's not, find the person that can take you on that journey.
Yeah, beautiful. All right, so the first topic that we want to talk about today is business structure. And for me, that's probably only something that I've learned a lot about, obviously through you guys, but in the last 3 years, and I would say even more so this year, just because of, you know, the business models that I'm trying to roll out. But I also know that, like, again, one of the things that I've learned is business structure can be great for tax purposes. It can also be great for incentives. It can also be great for how you grow your business, or, you know, and more importantly, taking you closer to your long-term vision and making things easier. Do you just want to start by maybe talking a little bit about business structure? What does it actually mean, you know, in basic terms?
Yeah. So so be really clear. We're talking about entity structure and like pros and cons of entity structure. Because when we talk about structure, we talk about that, or we talk about like how you structure remuneration, or how you structure organizational charts, etc. Mm-hmm. So when we're talking about like business entity structure, what we're talking about is like, are you going to be a sole trader? Are you going to be a partnership company, etc.? Most people wake up and go, hey, I want to start a business, and just go straight to the path of least resistance, which is like, I'm going to set up an ABN, or if they're going to get tricky and be complicated, they'll get a company set up and they'll just start, because it's, you know, no one tells them otherwise. What I would say is like, you need to have this conversation that we're going to have today around it, because it's expensive and hard to change later. So getting that structure right and getting that, you know, what we should be thinking about and doing up front with that end goal in mind. Like, you know, do you want to bring on business partners? Are we going to sell this one day? Like, what are the questions that need to be asked and answered to get that structure right? And most people don't even think about it whatsoever.
Awesome. So let's work through what those kind of options are then. So sole trader, you know, obviously starting a company, proprietary limited company, and then, you know, there's obviously the option later on to bring on partners and so on.
Yeah. So we'll start sole trader. Sole trader is pretty simple. It's, I decide I'm going to start a business. I go register an ABN under my name personally as like an individual. and I start trading. The reason people do it is it's essentially free to start. Downside of it is, one, I can't bring on any partners because I can't cut myself in half. Two, I carry all the risk of the business. So if something goes wrong at any point in time, I'm 100% liable. And no one plans for anything to go wrong. We'll talk about risk a lot today. No one plans for anything to go wrong, but no one planned for the Titanic to sink, or we get car insurance every day. Like, it's all this just in case stuff. And we'll talk about examples, but hand on heart, it happens more often than you realize that people are comfortable with the structures they have because we've done it right from the start. So there's that risk piece, and then there's the tax piece, which is, as an individual sole trader, you're paying tax at your marginal rate. It's all well and good when you're not making much money in day 1, 2, but once you're making 200 grand, 300 grand in this business, and be honest, that's why we're getting in business, is to make some coin. We're paying tax at 47%. So it's a lot of hard work that goes into giving, essentially half of it away.
Yeah, and I think the thing about that is, like, I've seen it even in some of my previous businesses around consulting is, someone starts a company. Same idea. You're like, yeah, this could go all right. It could go to shit. We don't know. All of a sudden, you're up to about 400-500 grand in revenue. You're up to your eyeballs in work. You're wearing all the hats. You don't have time to focus on changing the structure of your business, or your accountant doesn't. You get one email a year from him, and that's when your tax is due. So you've gone 12 months. You're up to 500. No one's organised it.
Yeah.
And all of a sudden you're paying 47% tax on 500 grand a year in revenue. And, that's what, nearly 250K, right, in tax. And
Killer.
So the difference is like, if you're in a company that's, only looking at like 27.5%.
Well, 25 now. So it's essentially half.
Yeah.
On the profit, not on the revenue, but same point. Once we're making that kind of money, we're giving away half of it. And 25 is still a significant number, but it's better than 47.
That's a good point that I just want to touch on. You are only paying tax on your profits, not on your revenue. So like, that's something that in the early days, a lot of people can get mixed up on as well.
It goes both ways. So what they do is they think about the taxes as a scary thing on the revenue, but in the other way, in the negative, people see the revenue coming through and think they've made 500 grand profit. But so hang on a second, no, we're still going to pay all these expenses. Conversation for another day.
But it's important, like, the difference in understanding that, like, even just from a tax purpose, because that's the difference between probably someone's wage that you could bring on.
100%. 100%.
And if you don't know, I've seen that, like, literally firsthand. Some of the clients that we used to work with.
That extra 100 grand in tax that's gone is a person that can grow the business.
Yeah, exactly. It's 100 grand that either could have been in your pocket or, could have been, used to bring on team and so on.
So let's, like, at least, except for the most minute cases, scrap sole trader. We're not doing it, kind of thing. Yeah.
Yeah.
Then their next thing they do is they go, hey, I've got a mate here. We're going to start a business together. Let's start a partnership because there's 2 of us. So that's kind of the next most common thing. Again, it's free, so they don't have to spend any money. They just register an ABN online. There's no resistance to the path. So it's pretty common for people to do that. But they've got the same issues. So again, as a partnership, you pay tax at the marginal rate of your share of the profits, and you carry all the risk of the partnership, which is actually probably a little bit worse in that if me and you are in business together 50-50, and we have 100 grand debt that we've shut down the business, we've got this 100 grand debt left over, you can't pay your half. I've got to cover yours and mine. I can't just say, I'm only liable for half of that. So, you got that issue in the partnership that you carry the whole debt of that partnership. So, again, there's circumstances where it makes sense, but very much like the sole trader, unless you're having a conversation about why am I going into this partnership, you should probably avoid it.
Yep. And then, so proprietary limited company.
Yep. So next thing we'll see is company. Again, probably where we start for the next level of sophistication. And we're happy with that. At least we got to a company. Benefit of the company is tax is capped at the company's tax rate. For most people will be 25%. And the risk, generally speaking, for most things sits inside the company. So if business goes bad, things aren't working and we want to move on with our life, we can shut down the company and move on with our life. We're not, unless we've signed guarantees and whatnot, we're not personally liable for some stuff.
Yeah, and so just so that people understand that, you've got sole trader, which you're liable, and then the difference is you're starting another entity which is your proprietary limited company, and all that's where the liability will sit with that company.
Correct. So it sits essentially, it's like a complete separate person if you want to think of that like that. It's not you.
Yep.
You own the shares of that company, but you're not that company.
Yep. And you talked about starting with the end in mind. Like, how does that start to weave into these kind of conversations and how people should start thinking about their businesses, no matter what they are right now? So, you know, there might be some sole traders listening to this. There might be partnerships. There might be companies. But, you know, what should they really be thinking about, and how does that affect the structure of the business?
So the things I'm thinking about are, am I building value within this business? So we didn't touch on trust. There's trust as well. And we can get to that later. But if I'm building a business that I want to sell, often I'm putting that inside the trust, or I'm putting it in a company where I plan to sell the shares. But point is, am I going to sell this business, or am I a carpenter that's just wants a vehicle just to trade under? I don't necessarily think that one day this is something I'm going to sell. There's kind of two different reasons to have a business. Both are fine. It's not that one's right or wrong. You just want to know, am I selling this one day, so we can get that structure right? Am I bringing on partners? So do I need to raise capital? Do I need an incentive plan where I need to bring on employees and have an employee share scheme? Like, what does that look like? Do I need to have multiple locations? Am I signing leases with Westfields and the corner shop next door? Like, what does that look like? Am I needing to protect IP? Do I want to have my IP sitting in the same place that I'm employing 100 people? So these kind of, like, I guess, questions are just to kind of get that structure right of what do we need to protect? Where does it need to sit? And what's the end game of this business going to look like?
Can you just touch on IP? I feel like that's really interesting. You know, something that I've paid a lot more attention to in the last 2 years.
Yeah.
And kind of what you mean by why would you
protect IP?
Why would you protect IP?
I'll give like kind of an example without mentioning names. Like, we've got a client now that has we'll call it a hospitality group. So opening these restaurant chains. Every time they open a restaurant chain, they're setting up a new entity to sign that lease in. So we have a company, we run the business in, we sign a lease. The lease is risky. The lease, we're signing a 10-year deal with a landlord that we're going to pay this $500,000 a year or whatever the number is of rent to run this business in this location. We're also spending X dollars on the fit out, and we're employing all these staff. So the operation of that hospitality business carries a lot of risk, and a lot can go wrong. The brand that runs under that hospitality business, we don't want to put in the same place that we carry all that risk. So what we do is we take the IP, we register a company brand name, domain names, secrets, like, the KFC, 10 herbs and spices, like secrets of the business, and put it into its separate location and essentially license that IP to the individual stores that operate. And we can then go, and every time we open that store in a new entity. So we let that risky venture sit in isolation. If something goes wrong, we can shut that one store, move on, and keep the rest of the brand without risking losing brand name, IP, secrets, etc. So when we talk about IP, we talk about the things that, the secrets of your business, the special stuff you have that sets you apart. We want to keep that away from the operation of the business. So if we need to shut something down, we can.
Yeah, so the operating entity is basically just people and cash.
Yeah.
And the IP...
Not even cash. So the cash, if we're building up cash in those operating entities, we're paying them out dividends to sit somewhere else. The operation entity is like risk, essentially. Anything that's risky, we'll let sit there. Happy days. We want to be in a position always, and that's that whole structuring conversation. We want to make sure we're in a position that we've got some flexibility to say, things are looking scary. We need to be able to get out of this one piece, but we need the rest of the business to keep going.
Yeah, okay. And that's where, like, you're talking about like a situation where you might have like a holding company or something like that is where cash is going into continuously. So not a whole heap of cash is sitting in that the operating entity, which is risky.
Exactly.
And then you've got the IP in a completely different entity. So that's really technical. And
we're getting bigger.
Yeah. If you get lost in that, but that's just I think there's, an interesting conversation around that for startups. I know that's something they run into. Recently I went out for brekkie with some friends, and they had a business name, didn't check that it was copyrighted, and 7 months into operating,
have to rename
after a really successful launch, had to rename. Now they bought the business name, but trademarking.
We had one recently. They've been running this clothing brand for 5 years. They have retail stores. Like, they've done a lot, and they have had their rename. And they're successful international business. It's like, people don't do that DD up front because it's like,
It
you're
is
starting out,
expensive,
it's
yeah.
expensive. You're not going to go spend $2,000 trademarking on day one. Ice will tell you he goes and he went and done his own trademarks because he's like, I'd rather spend the time than the money. Starting out's hard and getting this stuff right is expensive and you often don't have the money for it, but it is extremely valuable. And if it's not done, it can be extremely costly in 10 seconds. So, on day one, do we sit here and go set up every single structure that you need and do all that? Probably not, but have a plan and have some communication with someone that at the earliest point that you can afford it, you're getting it done before it gets too big or too risky. Yeah.
Do you have any examples and stories of how you can use structure to create really good incentives? Whether that's for staff members, partners, and talk about more of a bigger picture, how that can really help a business grow?
Yeah, I mean, the most obvious example is employee share plans. And they're common, obviously, in corporate world, as in if you go work at, say, a Coca-Cola or something, every employee will get their employee share plan. And it's really valuable because the company's listed and you can see it. But in small business land, you can do something similar. So all we're talking about there is saying, hey, I've got this really key person. I want to grow another location. Like, say we're running accounting firms. That's how Kelly Partners runs. We want to open another location. We find a key person, a gun person who's really good at their job, really invested. And we go, let's open, where are we now? Alexandria, Kelly Partners Alexandria. And let's give that person some equity so they got some skin in the game. They buy it, so they pay for that equity so that they've got that feeling of ownership. But they got the upside. And so as part of coming in there, whether that's 10%, 20%, whatever the number is, they're going to get a share of the upside of that location. It's an example of a really clear location base. You can segment that part of the business out and go, hey, anything that happens in Kelly Partners Alexandria, you've got a share of. Go grow it. Let's go together. Point of it is we're now aligned. If you're going to work building on that, obviously I've got some upside. I'll provide the IP. I'll provide the training. I'll help you get there. You've got some upside. You're going to do the day-to-day work in the detail, and we'll share the profits at whatever split makes sense. Yeah. Same thing can work in anything that's location-based. That's really easy. You can split locations out. As long as they're in separate companies, you can split equity in locations out really quickly. Do you need to do it as equity? You probably don't. You could do the same structure with a profit share model where you're just sharing the financial information. Doesn't need to necessarily be giving people shares. But I think there's a mental, emotional connection when you are giving them shares. So might not necessarily need to do it because it doesn't make a difference, but you need to do it because people need to feel like they're connected to the business almost.
Yeah, it's an interesting conversation. What do you prefer? When you are talking to this, say, gun person, it's and we'll touch on distributions next and kind of how that can work. But it's I think it's an interesting conversation of to what that person prefers. It's risky with shares because the business, may not, grow, right?
Yeah.
So that's a possibility. But then there's also the aligned incentive of now we're in this together and
let's go together.
It's game on.
And you as the owner, I think it's like you're saying there, it depends what the employee prefers. In my opinion, I think it matters what the owner prefers. As the owner, you need to set your business model and go, hey, this is the way I'm going to operate, and find people that fit into that model as opposed to trying to work a deal for every person differently. That makes sense?
Yeah.
If you're only going to do one deal, it's probably okay. Sit down, we're going to do this one thing and we can negotiate with that one person. But if I'm opening Kelly Partners in every location of Australia like Brett does, Brett came up with a model that works for him and the group and goes, this is what we're rolling out. We'll find people that fit that model. We're not going to fit a model to everyone else. That makes sense?
100%.
Because are you looking for people that have a long-term view, that want to have ownership, that understand what they're doing in that world? Or are you looking for an employee that wants no risk, quick fix, and just needs that money incentive? And what's the difference between the two for you as the owner?
How do you come to that decision? Because I think that's people would be sitting there now and go, that sounds really difficult to do. Does it have to be that difficult? But, I think I know that it's more about, okay, when you understand those incentives, when you understand structure a little, on a deeper level, it's more about how you manipulate and maneuver your way, or maneuver the business model, not manipulate, but maneuver the business model to kind of achieve what you want to achieve. And, it can increase things like speed of growth and more importantly, attracting great people and these kind of things. But how do you come to that decision of I'm just going to build, this kind of more centralized entity or decentralized?
I don't think it's we started with, you should start with the end in mind. And I think it's that conversation up front where you sit in a room with, whether it's a lawyer, an accountant, an advisor, and you, there's an unlimited number of questions, but there's a core kind of value questions and structure questions in terms of how you want money to flow and what you think the model should be, etc. Where if you spend half a day with someone in a room and teased out a bunch of things, you get pretty close to a model that works for you. I don't think there's a quick answer to that where it's like, hey, here's how you find it for you.
Yeah.
But I think it's spend some time going deep on a bunch of questions early on in your journey and start to work through, all right, these are the things that matter to me as the owner. These are the things this is how the business model could work and how I think the money will flow. Because you have to, if you're trying to do this kind of model, you have to do it in a way where it's like, I want to make a lot of people successful, with employees, business partners, however you want to look at it, because the more successful they're going to be, the more successful I'm going to be as the owner. So the model has to work in a way where you're trying to create success for everyone in it. You're going into business with, whether they're employees or business partners, you're going into business together. You're asking them to commit to your vision as the owner. They need to have upside in that. So sitting in that room, working through that stuff, on the back of that, you probably won't be in a perfect state, but you'll have at least a clear picture of roughly where you want to go. And then over the couple of years of going through the business journey, it will tease out a bit further. But I think early on, it's just understanding what's important as the owner and how you're going to build a model around that.
Can you just you talked about like this, or you kind of mentioned, I want to pull on that string a bit. It's like the mentality of, I find that it's a hurdle that even I had to jump at some point where it's like, no, like I actually need to really make this personal or make this decision going into business, not just trying to always think about everyone else, but actually go, no, I actually need to get value and benefit from this. And that should be the first thing that I think of. And it doesn't mean that it's the only thing you think of, but it should be the first thing and having a plan for that.
Yeah. I think it's interesting because it's a constant battle in your own head of, as that owner, when you're starting your business, like you're working hard and you spend so many nights building what you want to build, and there's this vulnerability to it where you're like worrying about, I'm bringing on these first few people, I feel like you have to give them everything, and the natural state of most people is to oversell what they have to give to that employee or business partner that they're bringing on board, because they're trying to validate the business they made. So we see it often where people come and they're like, hey, I'm going to give 70% of this and give away this. Like, why are we doing this? So I'd say like the conversation and the ideas there of make sure you're paying yourself first, and the model is going to reward you long term. But for me, it's about building a model. So I'm an accountant. I live in Excel. If I'm having this conversation with myself, I'm building out a model in Excel of what the 10-year plan looks like, and making sure that whatever I give away and understanding what I'm negotiating on a 10-year to 20-year window, not in a 10-second window. Because you start day one and you go, oh yeah, I'm going to go 50-50 on this deal, but you don't understand financially what 50-50 on this deal means in 10 years time, because you don't think about 10 years time. You think about the fact you're not making any money on day one, and it's irrelevant. So yeah, a lot of modeling and planning on a longer time frame. We're very impatient when we're younger and we can't see the future.
Yeah, and in the early days, you want to do everything you possibly can to just get to that next phase, but you're not thinking about what 3 or 4 phases down the line is, which is honestly, that's something that just working with you guys has probably made me think a bit more about as well, which is great. And even just building out my models, like, even on the plane here today, I was in Excel again and just remodeling some things, based on a hire that we want to make.
I do it weekly.
100%.
And the business doesn't change that much, but you just muck around and tinker, it's good.
100%. Now let's talk about like distributions and personal finances, and kind of just talking about, like I think we can probably talk about some examples of what we've talked about, company, sole trader, not sole trader because you don't make distributions there, but then also like holding companies and stuff like that. Like we don't need to go into too much detail about it, but just more about distributions, personal finance.
So I'll go through entity by entity, and then I'm sure you'll pull out stuff. So sole trader, as you make money, the money's yours. Like
Yeah.
it's what you're saying before.
That's your income.
That's your income. So if you make $100,000 profit, you pay your tax. Whatever's left is yours. We don't have to think about it too much. Partnership's very similar. You make your money, the money's yours. Yeah. When we start to get to companies, I won't go into trust again. We'll just talk about how money flows out of a company. When we go into a company land, we spoke about tax rate in a company being 25% and personal tax rate being 47%. Obviously, there's a 20% difference there, give or take. ATO are very protective of that 20% difference. They don't want you paying tax at 25% and spending that money personally at 47%. Like, what I mean by that is companies paid 25% tax. Danny goes and takes it and pays for a holiday for his family or buys a house or something. The government's missed out on 20% that an everyday person or an everyday employee would have to pay tax on. So that's protected. Yeah? We can't just go take the money out of the company and treat it like it's our money. So coming back to structuring and whatnot, what we're working at, and we'll talk about tax planning again probably in another episode, but what we're trying to work to is like, how do we get the benefit out of that money before we have to pay 47% tax on it? We touched really quickly before on the idea of holding companies. So often what happens is we'll have this trading business that's operating, makes its money, pays its tax, it starts to build up this cash in the bank account. The way to get the money out of that bank account, there's only really three ways, and the ATO treats each way differently. But there's pay a salary, which is pretty obvious. We pay a salary to ourselves, we pay our tax, we pay our super. Happy days, ATO has their 47% tax rate, they leave you alone. Second way is take a loan. So I've taken a loan from the company as an individual. ATO hates that, and there's a lot of rules around it about how I have to pay it back and charge interest and how it's going to get taxed if I don't treat it correctly. So short-term fix, it can work, but it's not a strategy for solving the problem.
And a loan can be, if you take money out of the company and it's not actually classified as an expense, it will become a loan.
A loan, yeah. So if I'm got my company bank account and I use it to buy my groceries, even though in my head I'm like, oh, I spent the company, it's like, yeah, cool. As an accountant, we treat that as a loan from the company to you. And you have to manage that. So a lot of work with clients is around managing this idea that the company's money is not their money and dealing with that treatment, I guess. So there's the loan. Short term, it's a strategy. We can use it. We do use it strategically, but it's not a solution for wealth building and getting money out on a long-term permanent basis. Next thing we do is we have like what we'll call it a holding company for the purpose of this convo. Operating company makes money, gets $100,000 profit it wants to pay out, pays tax on that money, so pays its 25% tax. It's got $75,000 left. It pays that out as a dividend. So dividend is a share of company profits that gets paid to the shareholders. Whether I'm my own personal company or I've got shares in Telstra, they all pay dividends out. It's how they share the profit of those companies. The dividend goes to the shareholder. So in the case where I have a holding company holding my shares in the operating business, getting technical here, a holding company holding the shares in my operating business, when that operating business pays out its dividend, it's $75,000 that it has left from the 100. That $75,000 will go sit in the holding company. So now I've got money in this holding company. It's already had its 25% tax paid on it. I don't need to pay the tax again because it's within a company environment still, so I don't get taxed twice. But it's out of the world of riskiness. So I'm not leaving that cash to build up in the place where I've got the lease and the employees and all the stuff that could go wrong of operating the business. I've got it sitting separately in a safe place, call it. Then we grab the accountant or the financial advisor or whoever we need to speak to, go, all right, I've got this $75,000. It's now safe. How do we invest it? How do we turn that now into, how do we get that money working for us? Which is really the secret of wealth creation. So, all right, I've got money. I can only spend so many hours working to make more money. How do I get the money to work for me? Getting that $75,000 now in the market. And there's now, we can go forever now on all the other considerations there around what entity should we invest in. But the idea is we pay out dividends to places where the money's safe, try to avoid bringing it into our own name because we don't want to pay 47% tax, and manage it from there. I will caveat that there are plenty of times where you need to get the money into your own name. So we have to manage that too because, the house price in Sydney's be lucky to get something under $1 million. So I need enough money to make my loan repayments, or I do want to go.
What's wrong with you guys up here? Well, you think you're special or something, huh?
Oh, mate, you're not far behind. Don't go, it's poor in Melbourne. Poor you guys. But yeah, point is we need to get money out in our personal world. So we do have to manage that. It's just managing, like, getting the least amount possible to live a good, happy, comfortable life, and leaving as much as possible in entities to keep the tax as low as possible to have more capital to invest.
And what's the impact over that over the long term?
Well, you're talking 20% a year, like, without running a financial number. You're saying if we every 100 grand, we're saying it's 20 grand that we're giving to the ATO instead of investing. The compound impact of that 20 grand over your life is massive.
Especially if like you talk about what that could do for your business if you invested it into your business and people and
well, even if you got in the compound interest calculator and said we're only planning to make 100 grand a year for the next however many years, I'll call it 20, and we're going to lose, if we took that money personally, we'd lose 20 grand extra in tax. So instead I'm going to invest an extra 20 grand a year at like a 5% return a year. Something as simple as that would still be millions of dollars difference in your lifetime. So it can massively add up fast.
And just on the back of that conversation around structure, and then we've obviously talked about distributions, personal finance, but like, how do you view wealth creation for business owners? And not necessarily technical numbers, but more just a mentality and a mindset. It's
actually a really interesting topic because it's not, I don't have a black and white answer for everyone on this. It's very much the stage of business and the stage of the person, in my view. Because, early stage in your business, your stars in your eyes, I want to grow everything, and every dollar I make, I'm investing heavily back into that business. And it probably makes sense for a lot of people to do that because that's a big home run swing at the bat. Like, if we can make that business fire, then happy days. But a business is a cash hungry beast and it will eat as much. If you're not planning your cash flow and managing your money, it will eat up as much as you let it.
Yeah.
So once we get past that survival stage and we start to get to the point where we can, forecast a regular P&L and we can see what profits the business should make, then it's like, all right, let's sit down with the owner and make a decision. We've got a model that should make 30% profit. When we get that 30% profit, let's talk. Like, do you want to take that 30% profit and reinvest it into more inventory to grow the business? Or do you want to take that 30% profit and pay it out as a dividend and go buy a property? The inventory can probably get you a better return if it sells through and everything works out, but it's more risky. The property will only give you, call it 7% a year return with capital and rent, but it's pretty safe, and we know in 10 years' time that 7% is probably going to happen every year. So you get to a point in that business where there's no wrong or right answer. It's just business owner, stage of business, make a decision. Don't live by accident. Don't just spend the money and keep spending the money without actually sitting down and going, all right, no, actually I'm deciding to spend on more stock because I know that I can grow this business versus buying that property. Yeah,
and it's also like, you talked about a 10-year plan before, but even just something from chatting with you guys was like, okay, I own 49 or 51% shares in this company, or 30% shares, whatever it is.
Yep.
And if we're targeting for a 30% profit, once we've got a build up of, the amount of cash in the bank that we want, we can start paying those monthly distributions, and then that's how we can
get the home loan.
We can start to understand what our income is, and more importantly, growing our income over time, and doing it, and we the stage of life that you're in as well. Like, if you're having kids, or if you're wanting to buy property and get a house, or whatever it is that you're wanting to do, like, understanding that for yourself is one of the, I think it personally is one of the, it's like a hidden treasure.
It's spot on. It's that model planning and that budgeting. And again, we'll probably talk about budgeting in another session, but it's that not living by accident. It's, hey, we have a plan for the year. We're budgeting this much cash flow coming out of the business. Let's pay those dividends monthly, getting that good rhythm happening. It's all just getting organized, really. And everyone's at a different stage of that. But the structures help. So if we go back to the topic of structures, all these conversations are only possible on the back of having a good structure.
Yeah.
I mean, they're possible, but they're a lot more expensive in terms of taxes and being able to bring on people and other issues. So getting that structure right early on understanding how it's going to operate and how the cash flow should happen. And yes, then we can talk about budgeting and dividends and how we're going to build that personal wealth on the back of it. But having that structure so you can operate without thinking twice and then build from there is super important.
Danny, mate, thanks for sharing your amazing knowledge. That was structure. This is part of like our new educational series. So if you enjoyed this episode and you want more, make sure you hit the subscribe button. It's super important. It really does allow us to get, amazing guests like Danny on and to share more of their knowledge and continue to do what we do. We're starting to change things up a bit as well. So appreciate the support. Danny, you're a legend. This is not going to be the only episode, but I can't recommend Danny and the team at Kelly Partners Northern Beaches enough. Have leveled me up as a business owner, but more importantly, are a big reason why I'm able to do a lot of the things I am right now as well. So yeah, massive wrap for these guys.
Much love, mate. Appreciate you. Have an amazing team in the background, so anyone needs help, reach out. But yeah, much love.
All right, guys. See you next week.
Hey, Danny from Kelly Partners Northern Beaches here. Hope you're really loving these conversations with Kyle. If you're looking for an accountant that wants to do more than just your BASs and taxes and be a real partner in your business, feel free to hit us up. We have an amazing team out on the beaches who deal with business owners every single day, looking to provide proactive advice, get in front of your business and help you make those decisions that are really going to make a difference in the long term for your life. Reach us anytime. If anyone wants to book in a free discovery session where we'll go through your business and see how we can help, hit us up at northernbeaches@kellypartners.com.au.